All right, welcome to this class where we're going to talk about lease accounting and how we actually report leases. Some of you are like, oh, I already know this. I leased my car. No, this actually, the accounting aspect of it is kind of interesting and unique, and you'll need to know it. So we'll go over what a lessee, lessor, capital lease, operating lease, financing lease, and what the differences are between them. Welcome to the lease accounting class.
Want to see my lease?
All right, so just from a high level review, a lease is renting an asset. That's what it is. So you could have a lease for a building, you're renting the building, all right? Lease for a car, you're renting the car essentially. You get the asset, you get to do generally what you want with the asset, and you make fixed payments over time with the asset. As the person that rents the asset, you are the lessee, all right? As the owner of the asset that rents it out, so if you're like Hertz or Avis or one of these rental car companies, you own the cars and you rent them out. You are the lessor, the owner. The way I remember it is has an OR in it, and that's how I remember the owner, lessor, because they both have O's in them. So the lessor is the owner, the lessee is the one that actually gets the asset and has to make those fixed payments over time. There's different flavors of leases, and these contracts can be written in a lot of different ways. And when they get towards a certain point, we call them a capital lease, where you actually have to put the lease, including the value of the asset and the lease terms, on your books as debt and an asset. And then an operating lease, which used to be off the books, but now is basically back on based on the new regulation from IFRS and US GAAP. And we'll talk about the different benefits, each one of those. Leases in general, as part of this review, they're an alternative to purchasing, and so there can be some advantages with that. So why do companies lease an asset as an alternative to purchasing? First and foremost, leases have some of the best financing for debt out there, all right? When you get a lease, the terms of that are not standardized like a bank. A bank, all they do is this stuff, and so they standardize the terms. When it comes to, say, commercial brokerage, right? So you're renting commercial property, you can get all sorts of different things, and it can be as creative as you want. There's all sorts of different levers you can pull. So I was involved with a commercial lease where we ended up getting, $750,000 in TI, and we didn't have to put anything down and no personal guarantees. It was a crazy, crazy good deal. And all of those terms came about because the landlord was really incentivized to get the place leased out, and we were really incentivized to walk if they didn't give us what we wanted. And so we got terms that you can't, like, we put nothing down and we got $750,000. That's crazy. That's nuts. But we were able to do it. And so these kind of terms you don't get at banks. And so that's a really big reason. So less costly. So the financing costs less a lot of times. You get better terms than sometimes banks will provide you. And then the last thing is that when you lease an asset, you kind of reduce the risk of the asset becoming useless over time, right? So you might be doing something in particular with the use of that asset, and then all of a sudden the need for that is gone. And if you lease it and have certain terms on it, you can just return it back and give it back. And so that can be an advantage with certain companies in certain situations. Attribute that frequently is mentioned, and it was mentioned more in the past than it is now, is that certain leases have certain financial reporting benefits. Keep in mind, anytime you hear anyone say, oh, there's a financial reporting benefit, you never do your strategy around the accounting, all right? Your accounting is for reporting how awesome your company is and killing it. Your strategy needs to be burying your competition, murdering your competitors, right? That's your strategy, not, well, this accounting rule will let us do this differently, and that might be better. If you're focusing on that, you're not focusing on what you've been hired to do. You've been hired to go out there and slay dragons. You're not slaying dragons by doing the accounting stuff. All right, so it's important to know because people try to convince you of it otherwise. So lease lies. Certain types of leases have perceived financial reporting advantages. I already went over that, all right? You don't want to have that be guiding on, just as a principle in general with accounting. That being said, you should be aware of what the old rules are so you can educate people as this comes up. Under old rules, you had these two big buckets, operating leases and capitalized or financing leases. In the IFRS, they call them financing leases. In the United States, we call them capital leases. Same potato type of thing. So what happened is there used to be a way to actually get things to be operating leases, but you essentially owned the asset, and it was more like a loan to buy an asset. And there were certain specific rules about leasing, and companies would thread a needle to make sure that the asset would stay off the balance sheet. But the reality is it should have been on the balance sheet, because what was going on in substance was a loan to buy an asset. Let me give you an example of what I'm talking about. So when I worked at the Stanford Endowment, I was part of a group, and one of the things that part of the Stanford Endowment was the land that Stanford owned. Well, the Stanford family, it was a farm, it was a huge farm, and the land's really valuable right now. And one rule that the Stanford family had was that the university could never sell any of the land ever. And so instead of selling the land, they entered into 99-year leases. Well, 99-year leases, those basically effectively, to a point, are selling the land. Sure, the land will go back after 99 years. A lot of things change in 99 years. And so as a result, this isn't effectively, while it's a lease, this is really a loan to buy an asset. You get the asset so you can do what you want with it, and then you have to make fixed payments back over time. That's exactly what you do with debt to buy an asset. You buy a car, you have to pay, you get a loan from a bank, let's say, you have to make fixed payments on that loan, and you get the car, right? And you get to do whatever you want with it. Lease works very similar. You get the car, you make fixed payments over time. The key is how long do you get the car? Is it Avis or Hertz, where you get the car for a weekend? Or is this a lease for like 20 years of owning a car? A 20-year lease on a car, you're effectively buying that car and then some, based on some of these lease rates. So the problem is that these firms were threading a needle on getting things off the books, so that it looked like they were getting a lot of returns with very little assets. And so the FASB and IFRS both didn't like this. They think this was gaming the system. And so they changed it. So under IFRS, it was IFRS 16. It was effective in 2019. FASB IC 842 similarly came into effect basically 2019 also. And so as a result, any old financial reporting benefit that people talk about that was there, first of all, you need to tell them, hey, look, we're not in this for the accounting. We're in this to win, all right? In the competitive market, we're here to win. Second thing you want to say is there's been updates to those rules. There's less benefits to leasing, all right? The other thing that is frequently brought up with leases on why firms lease is that they're trying to avoid technological obsolescence, all right?
First piece of free advice, you gotta listen, y'all make millions. Yeah. Never buy depreciating asset, okay? If it drives, flies, floats, lease it. Let's go have fun. Let's get it.
Right? So this means when the technology that you're using in a given asset is no longer valuable because it should be upgraded to the next newest and greatest thing. And that just sounds so good on the ears. Oh, just like, we get rid of obsolescence. Oh, it feels so good. It feels so right. Keep in mind, your firm needs to be aware of obsolescence in the sense that if you have things that are at risk of obsolescence, what you want those things to be at risk are things that are not necessarily core attributes of your business in a lot of ways, because the more core it gets to your business, the more you want to have that as part of like things you can figure out and deal with and adapt to and have that kind of knowledge inside of your business. And so the panacea of avoiding technological obsolescence, I would always question it. Sometimes it's a valid argument, and other times you're giving away your lunch to someone else, and they get the skill set associated with owning and that technology and making sure that they're aware of how it works and how it's going out of favor. And so keep that in mind when you hear these arguments for technological obsolescence within assets. So why did they do the change? Like I said, people were gaming the system, all right? And operating leases were the ones that you kept off the books. People were gaming it. They were basically saying, do you know what? We're going to try to keep things off the books so that we can say that, look, we're making a ton of cash flow, but we don't own anything, right? We don't have any assets under our control. And so really, in effect, they were getting a lot of loans to buy assets, but they were called, well, I shouldn't do quotes for that. They got a lot of loans to buy assets, but they were called leases. That's how I should do it. Loans to buy assets, but they were really called leases. And so they were using ways to get around it. And so they wanted to put the kibosh on that. Analysts, to deal with this frequently in the past, used to just do a quick shortcut. They used to say, okay, what's the lease expense? Multiply it by 8, put that on the assets and liabilities. And that was a quick way to kind of deal with the fact that a lot of these leases that are classified as operating should be really capitalized to the balance sheet and income statement, and should be capitalized to the balance sheet so that they factor into different ratios. All right, so here's the core difference between IFRS and US GAAPs when it comes to leases. All right, under IFRS, they only have financing leases. All right, if you have a short-term lease, it's an exception. We'll get to that later. But under IFRS, they just said everything's going to get capitalized and everything's going to be a loan. So what you do under a financing lease or these capitalized leases is you take the discounted value of those lease payments and you put that on the books as a liability. You put the same amount as an asset and you treat it as a loan to buy an asset. You depreciate the asset just like you would. You'd call it, in this case, a right of use asset. You depreciate that right of use asset over time. And then you have a loan, which you call a lease liability. And that gets written down based on the lease payments you make and the interest expense associated with those lease payments. Because effectively, that's what's going on. It's really, yeah, sure, you're calling it a lease, but really it's a loan to buy an asset. So that's the accounting they did for it. So under IFRS and US GAAP, both of them report it in this way. Both of them report a financing lease. And under IFRS, you're only allowed to do financing leases except there's this short-term option we'll get to in a sec. Under US, you're allowed to have this other operating lease. So the initial report, you report a right of use asset and a lease liability for all of them, all right? For all of them. Under the US, you're allowed this little alternative for operating lease. What you do is you recognize a single lease expense, which is a straight line allocation to the cost of the lease over its term. But the initial reporting is the same for both of them, all right? And the one exception to this for US and IFRS is short-term leases. And the quote goes for this, it's a lease at the commencement date has a lease term of 12 months or less and does not include an option to purchase the underlying asset that the lessee is reasonably certain to exercise. So if there's no option to purchase that discount option at the end of that 12-month term, then it would be something that we count as a short-term lease, and you don't have to capitalize it as you would finance operating under IFRS and US GAAP. So if it's a short-term lease, you don't have to do any of that. If it's one of these other ones, you have to capitalize the right of use and the lease liability. And so this is kind of a table that goes through the core differences for lessee related to the balance sheet, income statement, and the statement of cash flows. This is a good rule of thumb thing to have. Under IFRS leases and US GAAP finance leases, you recognize the right of use asset and lease liability on the balance sheet. On the income statement, you report depreciation expense because, hey, it's still an asset, so you're going to depreciate it. And you're like, wait, we don't own the asset. Doesn't matter. We're going to treat it like you do own it because that's what effectively is going on with the lease. So you report depreciation expense on the right of use asset, and you'd also have the accumulated depreciation associated with that. And then you report interest expense on lease liability. And that interest expense and the cash payments would reduce that lease liability. The statement of cash flows, the effective statement of cash flows are the reduction of lease liability is a financing cash outflow. All right. So as the lease liability goes down, it's a financing cash outflow. The interest portion of the lease payment is either operator financing cash flow from IFRS and an operating cash flow under US GAAP. The key differences there, we're going to get into the cash flow statement a little bit more in the next section, but an operating cash flow is something from your operations, and a financing cash flow comes from raising capital. And you might think, well, if it's just like a loan, then why is the interest not a financing? There's a good argument that could be made that it is a financing cash flow. It's just, this is how the rules worked out. Under the US GAAP, they basically say, you know what, this is part of our operations. If you need interest, then interest expense is part of your operations, and we're going to make that part of operating. US GAAP operating leases, you recognize a right of use asset and a lease liability, just like under financing leases. You report a single lease expense, and then the entire cash payment is an operating cash outflow for US GAAP. And the exceptions to include short-term leases, and under IFRS, leases released asset is low in value. There's no impact on the balance sheet on these short-term leases. They report rent expense, and the rent payment is an operating cash flow. And that's quick introduction to leases.
What do you think, Brennan?
I'm so scared right now. I'm gonna do what's sensible. I'm gonna file for unemployment, and I'm gonna try to get a job at Enterprise Rent-A-Car, because they got an excellent corporate structure, and they give you the tools to be your own boss.